IRA, the individual retirement arrangement. That's actually what it's called under tax code. We usually say individual retirement account, but it actually is individual retirement arrangement. IRAs. IRAs are available to people that have earned income. Must have earned income. And I mentioned this already. You can have a 401k and an IRA. You can have both. Must have earned income. There's going to be two categories of IRAs that we're going to discuss. There's going to be the traditional IRA, and then there's going to be the Roth IRA. How much can you put in? Is it unlimited? No, of course not. So the current year's contribution limit is the most you can put in. You can't put it the max into one and the other. It's the maximum into an IRA for the year. How can you invest the money in your IRA? These are common types of IRAs. Fixed dollar retirement annuities. So can an annuity fund an IRA? Yes. Variable retirement annuities, that would be fine. Bank certificates of deposit. Mutual fund shares, including precious metals funds, would be fine. Self-directed brokerage accounts, including the purchases of certain types of gold and silver. You are not permitted to fund an IRA by purchasing life insurance. You cannot buy life insurance within an IRA, and you cannot buy collectibles such as stamps, artwork, antiques, and precious gems. So silver coins, gold coins that meet certain requirements are okay. Collectible coins would be prohibited. You can even own real estate in an IRA if a lot of very specific tax rules are followed. So what can you do with those assets and what can you not do is generally a question. When you have a traditional IRA, the contribution may or may not be tax deductible. May or may not be tax deductible. The contribution made into a Roth is never tax deductible. So if it's never tax deductible, what that means is that it's funded, the Roth IRA, funded with after-tax dollars. Funded with after-tax dollars. The traditional IRA may or may not be tax deductible. So that when it's tax deductible, which we'll talk about the rule within your current year's contribution limits, you have a pre-tax contribution. If it's a pre-tax contribution, there's a zero cost basis. So what's the big deal? Why might you want to have a Roth IRA? People love them because when you take the money out, the earnings are federally income tax free. Are federally income tax free. So you fund it with after-tax dollars now, and then your earnings are federally income tax free upon withdrawal. However, not all of your clients will be able to directly fund a Roth IRA. There is an upper income limitation on the funding of a Roth IRA. So if your client earns this year too much, then they can't fund a Roth. If they can't fund a Roth, they have earned income, they can fund a traditional IRA unless they're over age 70 and a half. So the 70 and a half age rule is going to apply to the traditional IRA only. There is no 70 and a half rule on the Roth. So what does that mean? So long as the person has earned income that's not too much, they can continue to fund a Roth. The Roth also does not have the must begin distributions by 70 and a half rule. There is no requirement on the Roth to begin distributions. But on the traditional IRA, you cannot contribute after 70 and a half, and you must begin distributions no later than April 1st of the year after you turn 70 and a half. Otherwise, there will be up to a 50% penalty on what is called your required minimum distribution. So you might have a client that wants a Roth but can't directly fund it because they earned too much this year. They can always fund the traditional, however. Anyone with earned income who's under age 70 and a half can fund a traditional IRA. Whether or not it's tax deductible or not is according to this rule. So traditional IRA. If 1 and 2, okay, which I'll explain, the contributions are not tax deductible, which is another way of saying that they're funded with after-tax dollars. So the IRA is one of those things that the traditional IRA, is one of those things that in reality you always fund with after-tax dollars, but whether or not you can take a write-off on your personal income tax return. If you can take a write-off, then it's pre-tax dollars. Then it becomes a zero-cost basis. So if 1 and 2, the contributions are not going to be tax deductible. If you make too much, that's kind of vague, I know. You'll see. If you make too much and you are an active participant in an employer-sponsored plan. So basically what this means is that if you could enroll in a qualified plan where you work, okay, you're an active participant in an employer-sponsored plan, if you could enroll. It has to be both things. If you make too much, now that rule is going to change every year, so we'll discuss it in the video applicable to this current year. But it's going to be fairly obvious. A kindergarten teacher made $29,000 last year. Is that too much in anybody's mind? No. She does have a qualified plan where she works. Can she contribute to a traditional IRA? Yes. Anyone with earned income can contribute. I'm going to assume she's under 70 and a half in pre-tax or after-tax dollars. Pre-tax dollars. $29,000 a year is not too much money in any way, shape, or form. So just kind of go with your gut instinct. Your client made $300,000 last year. He does not have a qualified plan where he works. Can he fund a traditional IRA? Yes, anyone with earned income can. In pre-tax or after-tax dollars. Pre-tax dollars, meaning the contributions are tax deductible on his personal return. So yes, he made a lot, $300,000, that's a lot, but he does not have a qualified plan where he works. So both of these things must be true in order for the person to not be able to claim a tax deduction on their personal return. There is an upper income phase out on the Roth IRA, so not everyone who wants to have a Roth IRA can fund one. So you might find a client who would really like to have a Roth IRA, but they can't, they made too much. So what do? They fund a traditional IRA. Anyone that's under 70 and a half can fund a traditional IRA up to the current year's contribution limits. Then they can roll it into a Roth. It is the funniest rule. It's this kind of backdoor into a Roth. So years ago, there used to be a rule about how much you made, and if you made too much, your adjusted gross income was too much, you couldn't roll over from a traditional into a Roth. But that rule is now gone. So what happens a lot of times is when people can't directly contribute into the Roth IRA, they contribute an after-tax contribution into a traditional IRA, then they roll their balance into the Roth, which is perfectly legal. So it's a funny, interesting loophole that's still out there, unless the IRS fixes it. So that if the money that was in your traditional IRA has had any earnings, when you do the rollover, the earnings would be taxable, or any amount in the IRA that has not been taxed. Because it is true, any of your clients that would like to roll over, usually we roll from a traditional into the Roth. So if they want to roll over from a traditional into a Roth, they can do so. But any amount of the rollover that has not yet been taxed is taxable in the year of the rollover. and they're not getting any of that as a distribution. So they really do need to make sure that they understand that they are potentially creating a taxable event. Granted, what I see happen a lot of times is that, one day, Monday they fund a traditional IRA and Tuesday they roll it into a Roth, and there's really no earnings. So that the money was in after-tax dollars and then it rolls into the Roth. So it's an interesting way to get clients who make too much into a Roth product without directly funding a Roth IRA. We got to do the best we can for our clients, right? It's interesting. What are some other rules about the traditional IRA that I want to make sure that you know? Oh, the things that we talked about before. Ordinary income upon withdrawal, if you take money out under 59.5, a 10% penalty. We'll waive the 10% penalty for certain things. It's true on a traditional IRA that they'll waive the penalty due to death, disability, or divorce. That's true. Also, qualified higher education expenses. The IRS will waive the penalty. First-time homebuyer expenses, they'll waive the penalty on your IRA up to $10,000. So that's the maximum lifetime maximum for first-time homebuyer expenses. So I don't get into the definition of first-time homebuyer, but there definitely is a rule the IRS has as far as who qualifies for that. So if you wanted to take money out of your IRA, you can get $10,000 out. If you're taking out money that's never been taxed, it's taxable as ordinary income upon withdrawal, but we'll waive the 10% penalty if the money is being used for first-time homebuyer expenses. Rollovers have no penalty. Annuitization can be done at any time, even under 59.5 without penalty. They'll also waive the 10% penalty for medical premiums for unemployed individuals and medical expenses in excess of defined adjusted gross income limitations. So that one does depend upon the current year's rule for percentage of your AGI to itemize your medical expenses. So there's a much more exhaustive list of reasons why they'll waive the 10% penalty when you're under 59.5 from your IRA. It's also true that if you have an IRA, a traditional IRA, and you have a non-working spouse, you can open up a spousal IRA for that individual and then contribute into that account up to the current year's maximum. So a spousal IRA. 2 separate IRA accounts are required. When you have an IRA, you can fund it up until the tax due date of April 15th for the prior year. So up until April 15th. There is a limitation on how much you can put into an IRA. If you fund it with more than you're supposed to under that current year's tax code, there is a 6% penalty tax, and that's charged on the excess contribution until you take it out. So a 6% penalty tax. How can you take your money out of a traditional IRA, an entire lump sum distribution? So it's important when you look at a traditional IRA to keep track of its cost basis. It's possible in some years you had a pre-tax contribution and in some years you had an after-tax contribution, so that when you take money out, some of it might be taxable and some of it might not be taxable. It is possible to have a mixed cost basis. Of course, your earnings have not yet been taxed, but it is possible to have a mixed cost basis in a traditional IRA. You can annuitize based upon your life expectancy or the joint life expectancy of you and your spouse. Always ordinary income on qualified plans, never capital gains taxes, always ordinary income. What would happen to an IRA should the IRA owner pass away? So at the death of an IRA owner, the distribution options depend on whether or not the IRA owner died before or after account distributions began. Don't forget, traditional IRAs do require the beginning of the distributions at minimum, the required minimum distribution, no later than April 1st of the year after the client turned 70 and a half. If the account owner did not designate a beneficiary or name his estate as beneficiary and dies before distributions begin, the account balance will be distributed according to the 5-year rule, which requires that the entire amount in the IRA be distributed no later than December 31st of the 5th year after the owner's death, either as monthly payments or as a lump sum. However, if the IRA owner died after distributions began, the account balance must be distributed according to the terms selected by the owner. If the IRA owner designated a beneficiary other than their spouse and dies before distributions begin, the IRA must be distributed in accordance with the 5-year rule. So the 5-year rule that we just talked about. However, non-spouse beneficiaries also have the option to receive distributions over their life expectancy as long as they take the initial distribution by the end of the year following the death of the IRA owner. Non-spouse beneficiaries may not roll over an inherited IRA into their own IRA. So when you have an IRA, you can designate whoever you want to be your beneficiary. Those were the rules if you designated someone other than your spouse. If the IRA owner had already begun to receive distributions at the time of death, the remaining distributions must be paid out at least as rapidly as they would have been under the method of distribution in effect prior to death. So when they're taking the money out, the IRS doesn't want to lose their income stream, so they must continue to take the money out at least as rapidly as it was in effect. However, there's special rules if the surviving spouse is designated as the IRA beneficiary. So when the spouse is named as beneficiary, they can elect to treat the inherited IRA as their own IRA. If the beneficiary elects to do this, they become the IRA owner for all purposes and will not be subject to the required minimum distribution rules until the surviving spouse becomes age 70 and a half. It's also possible the surviving spouse may designate a new beneficiary and elect to receive distributions based upon their joint life expectancy. So if you do that, you choose to have your beneficiary be a child and you elect payouts based upon your average life expectancy. Basically what you're doing is taking a smaller amount, stretching out when you're going to owe the income taxes. So some specific rules. I don't think that there'll be a big deal on your exam. More important when you took your Series 6. We discussed Roth IRAs. We know that people that have earned income, no matter their age, can contribute to a Roth IRA so long as they don't earn too much. Something that's interesting though, sometimes you'll have clients that file their taxes married filing separately to avoid some marriage tax penalties that are built into the tax code. They're definitely trying to get rid of those marriage tax penalties, but they haven't totally fixed it so that some people that earn a lot will file separately to reduce their taxable income. People that do that are not eligible to contribute to Roth IRAs. Interesting. We know it's always after-tax dollars that go in. Earnings are federally income tax-free on your Roth IRA if it's a qualified distribution. So let's remind ourselves of something. I like to call a Roth IRA a glorified savings account because after-tax dollars go in. And these are your dollars that go in, and you can take your dollars out at any time, no tax, no penalty. If you were to put money in this year and take the same amount of money out next year, you can take that money out, no tax, no penalty. It is your money after all. It's after-tax dollars that went in. So in that respect, out of a Roth IRA, your distribution's FIFO, first in, first out. Granted, if you put money in this year and take it all out next year, what's going to earn anything? There's not going to be any money in there to earn anything, but it is important to realize that people can do that. Now, the big selling point of these is that we have federally tax-free earnings if it is a qualified distribution. Qualified distributions tax-free. So how do we get these earnings out tax-free? Earnings out tax-free. There's 2 steps to this rule. The account must be open for a minimum of 5 years. So they have to have made their first contribution a minimum of 5 years ago, and the earnings are paid out on or after 59 and a half. On or after 59 and a half. Once again, this is the rule to have the earnings, which of course I cannot spell. Spelling and talking is always harder than I thought. The earnings, in order for them to be federally income tax free, these 2 things must be true. The account must have been open for a minimum of 5 years, and the earnings must be paid out on or after age 59 and a half. So, huge benefit to Roth IRAs. They also are not subject to the 70 and a half rule, as we have discussed. We talked about rolling over from a traditional into a Roth. Whatever amount you roll over that has not yet been taxed is taxable as ordinary income. If the person should get the distribution into their hand, it's not done trustee to trustee, the 60-day rollover rule would still apply. Education accounts. Back in my day, there was no education accounts for my parents to save for me to go to school. They just had what were called UGMA or UTMA accounts. So accounts where they were set up for the benefit of a minor. Some states are Uniform Gift to Minors Act states, and some states are UTMA states, Uniform Transfer to Minors Act states. That was back in the old days. Today, there's 2 different types of education accounts. So we have the Coverdell Educational Savings Account, which when it was first introduced was called the Educational IRA, until they realized that it wasn't a retirement account at all, so they did away with that name. It was a terrible name. And then the newest entrant into this educational account is the 529 plan. So Coverdell Educational Savings Accounts and 529 plans. So I'm going to compare and contrast these 2. Can a person looking to save money for educational expenses, can they have both of these? Sure, absolutely. Maybe they would. I don't know that they need them both, but they can. You'll see where there's some interesting distinctions between them. So the Educational Savings Account and the 529 plan, they're both funded with after-tax dollars. They're both funded with after-tax dollars. After-tax dollars. The Coverdell Educational Savings Account must be set up for a minor, so someone under age 18. Where the 529 plan may be set up for anyone, I love school, love school. The biggest joke is that I'll get my PhD when I'm 80. I will, I swear I love school. So I could have a 529 plan for myself, doesn't matter my age, but I can't have an ESA, no. So for your minors, children, under age 18. The 529 plan is a type of municipal security. It's a type of municipal security. It varies by state. The ESA has a limit as to contributions on an annual basis. What the limit is, I will discuss in that limit video for you on an annual basis. But this is, if I had to say of the 529 plan and the ESA's limit is always much smaller. Into a 529 plan, any person who wants to do this can put in up to 5 times the current year's gift tax exclusion. So, years back, my mom called me up and she said, hey, I just read this wonderful article. Did you know that I could put 5 times the current year's gift tax exclusion into a 529 plan for your son, Miles? And I said, I did. Would you please? And Grandpa could do the same thing. And then they could also do it for Mason and Max and Emery. So you can get a lot of money in there quickly. Why are these accounts popular? The earnings in both of these are federally income tax free if used for educational expenses. So the 529 and the ESA, so much higher contributions can go into the 529 plan. This ESA not only has a limit as to how much you can put in that's pretty small, it also has an adjusted gross income limitation so that if your client is earning too much, they can't contribute to the ESA at all. There is no income limitation on contributions to be made into a 529 plan. So anyone can contribute to a 529 plan. It doesn't matter their age, it doesn't matter if they have earned income or not. Into the ESA, they don't have to have earned income to contribute, but if they earn too much, then they can't contribute at all. So that's important. Earnings federally income tax free if used for educational expenses. There is a distinction though on these two, they are different. For the Coverdell Educational Savings Account, when we talk about educational expenses, earnings being federally income tax free if used for educational expenses, we are talking preschool through higher ed. So through graduate school, through medical school. So even to fund a private preschool. So you just had a baby and you know you're going to want to send her to a private Catholic high school and those are expensive. Start saving now. With the 529 plan, it's higher education only. So we're not talking high school or preschool or middle school or elementary school. The earnings are federally income tax free if used for higher educational expenses. Now, both of these do have this idea that, let's say I set it up for my oldest boy, his name is Miles. Let's say it's an educational savings account. Educational savings accounts under age 18 to set it up, they do have a must use by age 30 rule. Must use by age 30. With the exception of special needs children who do not have to use the funds by age 30, but everybody else must use the funds by age 30 or roll it to another family member. So exactly how far can you roll it down your family tree? You'd want to read the plan documents about the ESA. You're going to have the same rule for the 529 plan. Generally speaking, 529 plans, it's not, I'm not going to give you advice for trying to get college funds for your child, but how an asset is weighted when you do that FAFSA financial aid form. If the asset's in the child's name, that's like the worst it can be. If the asset's in the grandparent's name, that's sometimes pretty bad too. Better to have a 529 plan in the parent's name, and then for the benefit of the Miles in my story. And then if Miles doesn't use the money, I can change it to Mason, and then I can change it to Max and Emery's children. You can roll these assets quite a long ways down the family tree. So you would want to read the plan documents for how far can you roll them. If so comes the day that you need money out of one of these plans and you're going to be taking earnings out for something other than what they were designed for, maybe you're going to use it to remodel your kitchen. Both the 529 plan and educational savings account, you will have to pay ordinary income tax on the earnings, and there will be a 10% penalty on those earnings because you are not using them for what they were intended for. So, much more popular today to have a 529 plan than it is to have an educational savings account. But like I said, you can have both. You can have both. When you are a registered representative or a registered principal, you do have to have an annual compliance meeting. So the supervisory procedure rule, which is NASD Rule 3010, until it changes into a FINRA rule, which it will someday, requires the participation of each registered rep and registered principal, either individually or collectively, no less than annually, in an interview or meeting conducted by persons designated by the member, at which compliance matters relevant to the activities of the representatives and principals are discussed. So this annual compliance meeting every year, registered reps and registered principals are subject to having to attend this meeting. The interview or meeting may occur in conjunction with the discussion of other matters, that is fine, and may be conducted at a central or regional location or at the representative or principal's place of business. It is possible today. It does not have to be done in person. The interview or meeting may be conducted by video conference, interactive classroom setting, telephone or other electronic means, including webcast, provided certain safeguards are in place. Members choosing to conduct meetings other than in person must ensure that the communication forum allows for interactive communication with the representative. This means at a minimum that attendees are able to hear the presenters live and in an interactive environment ask questions and engage in dialogue with the presenters. So that's really common, that you go to a big conference room and the person's at your home office, which is many, many miles away, and to save money, we just do it via video webcast. So this is an annual compliance meeting. Could they have meetings quarterly? Certainly, but they can have them no less frequently than annually. So definitely something I expect you to have on your test. Once you get licensed with your Series 6, with your Series 26, you are required to continue to learn. So you're going to have, of course, continuing education requirements. So the continuing education requirements are per person, not per license. So whether or not you have a Series 6 or now you're going to have both your 6 and your 26, you only have to do these items one time, so that's good. We have two rules. There is the regulatory element and the firm element. So regulatory. So continuing education requirements, firm element. So the firm element is done internally within your firm. It must be done annually. So could we do the firm element and the compliance meeting at the same time? Yes. They are talking about different things though. So usually FINRA is going to publish once or twice a year items that they find through their examinations. Broker-dealers are having a hard time with, maybe rules that aren't being followed, maybe there's a new product that's been created, so that FINRA will publish some information so that your firm knows what kind of information they're supposed to communicate to you at your firm element annual continuing education meeting. So all registered individuals who have direct contact with customers must attend this annual written training meeting, making sure that we understand the current rules, current products that are in effect. This would include a review of suitability standards and sales practices, of course. So registered reps and registered principals. So this is just done internally within your firm. The regulatory element is actually done at the testing center. So wherever you take your Series 6 exam, wherever you go take your Series 26 exam, they give a test. It's a case-based exam. So you read a case and then you answer questions as it relates to the application of FINRA rules related to the case presented to you. It's not real easy to study for those regulatory exams. They're not too bad though. You just have to carefully read the case. When do you have to do it? All registered persons must complete a computer-based training session concerning regulatory and compliance developments within 120 days of your second registration anniversary date and every 3 years thereafter. So every 3 years. I'm assuming you're in that area of time within your license, but I'll put the whole rule. Within 120 days of your second registration anniversary date, and then every 3 years after. So actually go back to the testing center, regulatory element. If you didn't pass it the first time, you just go and retake it. It's no big deal. Firm element done every single year. That includes our discussion for training of representatives. That's a big chapter. It's a review of most everything you learned. Don't forget to read your key facts, practice your section quiz, your ultimate goal, getting to 90% or better. Have fun.